Ladies and gentlemen, good day, and welcome to the Q3 and 9 months FY25 earnings conference call of Yasho Industries Limited, organized by Orient Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during your conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Masoom Rateria from Orient Capital. Thank you, and over to you.
Thank you. Good evening, everyone. Thank you for coming to Yasho Industries Q3 and 9-month FY25 business call. Today, we have with us from the management Mr. Parag Jhaveri, the Managing Director and CEO, along with Mr. Deepak Kaku, the CFO. Before we proceed with the call, I would like to give a small disclaimer that the call may contain certain forward-looking statements which are based on the business opinions and expectations of the company as on today. A detailed disclaimer has been given in the company's investor presentation. I hope everyone had a chance to go through it, which was uploaded on the stock exchange. Now, I would like to hand over the call to Mr. Parag Jhaveri. Over to you, sir.
Good afternoon, ladies and gentlemen. On behalf of Yasho Industries Limited, I extend a warm welcome to all of you joining us for today's result call. We greatly value your time and interest in our company's performance. As we discuss our financial and operational performance for the past 9 months, I would like to emphasize our unwavering commitment to maximize value for our stakeholders. Despite the ongoing volatility in market and the slowdown in the global chemical industry, we have skillfully navigated this period of uncertainty. In the face of these challenges, we successfully maintained our revenue, achieving a total of rupees 148 crores for the quarter, which represent a 15% year-on-year increase, driven by an 8% improvement in sales volume. Our reporting margins have been effectively protected and enhanced through a more efficient product mix, resulting in an EBITDA margin of 18.4% for the quarter. Our Pakhajan facility is now running smoothly, and we expect the plant to run at more than 50% capacity from March 2025 onwards. We believe that this expansion, coupled with our proven operational resilience, will lead to stronger sales and continued success for the company. On a global scale, our subsidiary in the US will serve as a key distribution hub for the American customers, laying the groundwork for future growth and network expansion. Looking ahead, we understand that chemical prices have stabilized and expect to see consistent pricing for the next few months. We are actively working on increasing the utilization of our new facility. We recently concluded a rupees 125 crore fundraising through a preferential allotment. Fund will help the company strengthen its balance sheet. The fund are intended to pay off borrowings, some long-term, and for the working capital of the new facility. We also intend to upgrade our R&D facility, which will be done in the next few months. Talking about financial highlights for Q3 FY25, our revenue from operations for the quarter reached rupees 148 crores, reflecting a 14.7% year-on-year increase, primarily driven by significant volume growth. Notably, export accounted for 66% of our total revenue. We successfully maintained our margins on account of improved product mix and of cost efficiency, enable us to achieve an EBITDA of rupees 27 crore, resulting in an EBITDA margin of 18.4% for the quarter. The segment-wise contributions stood at industrial chemical contributing 79% and consumer being 21% of the total revenue. For the 9 months ended December 2024, Our revenue from operations totaled rupees 486 crore, demonstrating a 15% year-on-year increase. Our EBITDA reached rupees 83 crore with an EBITDA margin of 16.8%. The PAT stood at rupees 1 crore due to increased depreciation and finance costs resulting from the commencement of a new plant at Pakhajan. In conclusion, we are optimistic about further enhancing our margin as we focus on customer engagement and maintaining stable operations while ensuring steady contribution margin through better cost management and product mix. Our commitment to creating long-term value for our stakeholders, coupled with prudent financial management and strategic initiative, will be instrumental in sustaining our growth in coming years. So that is from my side. We will now open the floor for question and answer. Thank you very much.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the first question on the line of Anirudh Shetty from Solitary Advisors. Please go ahead.
Thank you for the opportunity, sir. Just a few questions from my side. The fundraise that we've done, has that, just to clarify, has that been entirely done to pay off debt, or is there some CapEx component there as well? And if you could just give the split if there's CapEx as well.
From this 125 crore, 50 crores we are repaying the debt, and balance we are going to retain with us for the use of future expansion work.
Okay. And this CapEx, is it primarily in the industrial chemical segment, or is there some new opportunity that we are looking to cater to?
It will be into the industrial segment only, but for the new molecules, new product.
Got it. So, our consumer chemical business in the, Q3 FY25, 9 months FY25 has grown very, very strongly. So just want to understand, what has been driving that growth, and is this sustainable growth, or do you think that it could reverse in the future?
No, it will be one time. We don't expect that to grow. This is purely our sales into industrial segment was little subdued due to the demand, and also the year end for a lot of our customers, MNCs, being a December month, we did not able to push the sales. That's why the consumer looks to be much higher, but which will not be in reality going forward.
Got it. Because even in absolute terms, if I just look at the revenue, it has grown quite meaningfully, not as a percentage, but just in absolute rupees crores. So has that been more like pricing-led growth or volume-led growth? Just want to understand what.
That was a volume and pricing both.
Okay. Yeah. Just one final question. In this quarter ended, what would our capacity utilization in Pakhajan be?
Well, in December, we were almost close to 30% utilization. Okay, but the sales did not materialize. As I said, that lot of sales happened in January purely due to the customers closing.
Got it. No, thank you for taking my question.
Thank you.
I'll turn back in the queue.
Thank you. We have the next question from the line of Yash Dedia from Maximal Capital. Please go ahead.
Hello. Thanks for the opportunity, sir. Sir, I wanted to know any other reasons were there for lower industrial chemical volumes uptake and lower capacity utilizations. When we predicted in Q2 that our capacity utilization would be, say, about 35-40% for Q3 and 60% for Q4. now we are lowering that guidance again. So, what is the key reason behind it, apart from seasonal impact which has happened due to holiday seasons for US and UK players, EU players? Apart from that, any other key reason?
No, I think the major reason in Q3 was customer holding back the supply or accepting the deliveries. So that was one of the reasons. Yes, we are little bit lagging behind in our ramping up production and sales, at least by 2 quarters. What we are expecting in month of September, that is going to happen in the March 25, and we can see that yes, there's a delay for 2 quarters purely because of some of the approvals that the customer has and has been held up, and some of the customers' RFQs have been delayed, or I won't use the word delayed, but they are getting due end of or mid of the next year, mid of 25.
Sorry, customer RFQs are getting? I didn't get that part.
Customer RFQ coming. See, the customer has
So they are going.
our major customers runs on a yearly or 2 yearly contract. That they should raise RFQ for the new purchase. So that is going to come somewhere in July, August.
And that was expected to come earlier when?
Well, there are a couple of one which has got delayed, and a couple where we could not got the bid because we are not fully qualified with them.
Achha.
Now we got qualified.
Now we are qualified and confident.
Yes.
And going forward, so we are expecting Q4. So March should be 50% utilization, and blended Q4 would be around.
It's two thing, but about 35% blended Q3 will be. 35 to 40%. 35 to 40% blended. 35
to 40% blended. And in FY26, by when we expect, say, it would utilize optimally, which we were
by the last quarter of 26.
Last quarter of 26. Okay. This would be the exit run rate, correct?
Sorry?
This would be the exit run rate. By the last quarter, we will be exiting
85 to 90%.
Okay, understood. Thank you, sir.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question on the line of Manish Gupta from Solidarity. Please go ahead.
Parag bhai, 2 questions. First one is, can you provide some color on your conversations with customers in the light of, all this we are hearing about tariff wars? How are your customers in the US thinking about their supply chain sourcing requirements in the light of the new administration's desire for higher tariffs? Can you give us some color on how your customers are reacting to that?
Well, everybody's cautious. I think it's too premature to make a comment. Only one side they are certain that the 10% tariff which has come on China will remain. The rest of the tariff, they are not sure how far that will be or what is the reason that those tariffs are coming. We are into chemical. In chemical side, we see that there is a tariff coming on a product coming from China. There is not a clarity that certain products which were exempted are part of this or not. We are waiting for that clarification from our customers. But we may see a higher traction in going forward in coming weeks. I think this just happened before a few days, so it's too early to talk about its impact on the business.
Specifically, Parag bhai, if, for example, there are higher tariffs on our products, say for the US market, as of now, I don't think we serve the US market very, very extensively. So if there are higher tariffs on our products, how does our strategy get impacted?
Manish, we are not anticipating that there will be a higher tariff on Indian products getting into USA. We are quite a bit certain. if there will be any tariff, it will be across the board, not only on a product originated from India. As of today, what we have a conversation with our friends. So if this come really as a higher tariff on Indian product, that's going to surprise everybody. Okay, but looking at the pretext, what the media and what we are hearing from the people, India is not going to be punished badly on a tariff side. That is what our assumption.
Next question, Parag Bhai, is that, when are both our plants, Dahej and Pakhajan, when both our plants are optimally utilized? Now I think you have a better sense of pricing in the market and, what gross margin we could do from the plants whenever we reach optimal utilization. What will be the approximate aggregate EBITDA run rate of the company at that point in time?
First of all, both the plants not in Dahej and Pakhajan and Vapi. So let me just make that small correction. We are expecting a revenue in the range of about 950 to 1,000 crore for FY26. At a minimum EBITDA range between 17 to 19%. We are confident on that part of it. In FY26, 1,000 and FY27, which we assume that we will be running both the plant right from day one on a full capacity, should be in the range of about 1,250 to 1,300 crore. With again EBITDA margin in the range of about 18% plus minus 1.
Okay. So roughly say 220, 240 crore is at peak utilization. What the EBITDA capacity of the plant?
Yes, sir.
Okay. Last question, Parag Bhai, that, the ramp up now that you are guiding to, have you got all the approvals that you need on the product side? Now, is it just a question of sales execution, or is it also delays in, product approvals?
If I say all approvals, answer could be yes and no. If I have 10 customers, from 6 we got all the approvals, 4 are still under evaluation level. So I won't say 100% approval, that cannot be ever happen. So it's an ongoing process. Approval, new customer will come on board and approval will continue. But yes, some couple of key major customers whom we have identified as a business for future, as we have received it. And from them we have received some part of the business also, or for some part of the world.
Excellent. Thank you so much.
Thank you.
Thank you. We have the next question on the line of Parth Agarwal from Bastion Research. Please go ahead.
Hi, thank you for the opportunity. So I have just one question. So since, our Pakhajan facility, we are expecting our asset turn to be around 1.5 to 2 times, right?
Yes.
So can you just give me a sense on, let's say, both the facility, Vapi facility, I think it's anyways optimally utilized right now. And if Pakhajan facility were to be optimally utilized, what would be the EBITDA margin that would be generating from that Pakhajan facility?
I will not going to have a plant-wise EBITDA, but I can tell you on the company level, EBITDA will be plus minus 1% of 18%. That's what I can give you. We will not be able to share with you the plant-wise EBITDA. I'm sorry.
That's right. Okay. So what I'm trying to understand is, since, our Vapi facility almost does an asset turn of close to 3 times, and this new facility will do an asset turn of around 1.5 to 2 times. So it should generate sufficient margin, incremental margin to compensate for the ROC that is, that might get depressed, right? So I'm just trying to understand whether this Pakhajan facility is ROC accretive or not.
Well, Pakhajan facility is not fully monetized. It will take at least to monetize the full assets of Pakhajan, we will need 3 years minimum, 3 to 4 years, purely because we have spent about 250 crores on a peripheral infrastructure creation.
No, so let's remove
the production capacity is too meager. So unless until the second phase of expansion and whatever not kicked in, which will help us to utilize those assets, till then you will not see the return more than 3 times. So that will take a while for 2 years more from here.
Okay, got it. Thank you so much.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Shubham Jawar from Dexter Capital. Please go ahead.
Yeah. Hi, am I audible?
Yes.
Yeah, hi, sir. Thank you for the opportunity. I had a couple of questions. So the first question was, our industrial chemicals contribution this quarter was 79% compared to 87% in last year, same quarter, right? Hence, with the higher margin industrials contribution lower this quarter, what exactly led to our gross margin being expanded so much?
Okay, that's purely because of some of the product mix, what happened at our end, which has helped us to increase the margins on the product.
Sir, but my understanding is that the industrial chemicals was the higher margin product, right?
Yes.
So when industrial chemicals is itself down to 79% compared to 87% last year, same quarter, so then, sir, what exactly is leading to such high gross margins when the higher margin industrial chemical is down itself?
Just said I cannot pinpoint which product line which gives us a margin, but there are certain new products which is, I won't say new, but the product which was been sold low quantity but high margins in industrial segment has been sold in a larger volume than what is, that is helping us to achieve a better margin.
All right. And so, what is our, will this margin be sustainable, this gross margins?
I think gross margin of about 38 to 39% is a sustainable margin.
All right. Okay. Also, sir, the second question was, if I heard it correctly, out of 125 preferential round, that 125 crores preferential round that we did, right? We would be using 50 crores, around 50 crores for the debt repayment, and remaining we would be earmarking for future capex. Is that understanding correct?
Yes, right now it will be used for the routine working, but that money will be eventually used for future expansion in the 25-26.
From 25-26 onwards itself, we would be using that for expansion, right?
Yes.
All right. Okay, sir. And so, if I may ask, what is the current inventory this quarter, if that is available?
I think current inventory was much higher. Purely, as I said, that a couple of order were put on hold. So current inventory was in the range of about 260 crore, much higher than what we expect or what we generally believe. And I think we will be bring it down back to normal by March. The way what we see the traction of new orders, that will be come down.
All right. And sir, what is the pricing trend that we are currently observing this quarter, and how confident are we that this may not slip again in coming quarters? Like, what is the general understanding there?
Well, I don't have crystal, so I can't talk about what will happen. We have seen some price improvement starting from mid of January. And we have not seen any further deep into the raw material prices, but we have seen somewhere the prices started moving up. Not only the one field, but across the board, we have seen that the prices are started rising. People are complaining that we are not able to maintain such a low price. That's kind of murmurs are happening. So, whatever new prices we are getting or we are seeing for Q2, sometimes we start negotiating at this level. So we see that price increase.
All right. Okay. That was it. Thank you so much.
Thank you.
Thank you. We have the next question from the line of Nakul Doshi from MS Associates. Please go ahead.
Thank you for the opportunity. I had a couple of questions, starting with considering the current market dynamics, including customer demand, pricing trends, industry conditions. What are your projected volume growth for the current quarter? That is Q4.
Current quarter, we should be having a volume growth, aggregate growth of about 30-35% by end of the year as an aggregate growth.
Okay. And annualized basis, what would be our total FY25 figures?
FY25, we should
Expectation.
650, 670 crore, somewhere in that range, we will be ending up.
Okay. And on how is the new subsidiary contributing to enhancing our market position and expanding our distribution network in the American market?
That subsidiary will start operating, selling the product from the next month, because we just complete all the formalities over there. We will start moving the product to our warehouse in Houston. So actual revenue will start generating from March.
Okay. And have we set any key milestones for the particular subsidiary? Like in midterm, do we have any targets set for the same?
I think let us start working, then we'll talk about the targets, my dear friend. It's too early to talk about the target for the new setup altogether with a different geography.
And additionally, are there any plans to set up warehouses or establish any new subsidiaries in other regions to further strengthen our global footprint?
No, right now only the two, Europe and USA. It could happen in USA, the multiple locations going forward. How we see the business growth, depend on that, we'll take a call.
Sure. That's it from my side.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Sunidhi Joshi from NM Financial. Please go ahead.
Hello. Am I audible?
Yes.
Okay, so to begin with raw material, can you provide more details on the impact of raw material pricing that you see going forward? Also, if you can help us understand how do you manage the fluctuations in raw material costs to maintain profitability?
In past also we have said that wherever we work on a long-term relationship with a customer, our pricings are on a quarterly basis. And anything happen during the quarter, we don't. Either we absorb or we gain or we lose. But end of the quarter, we renegotiate the price depending on the situation. And I think over a period of time, we have demonstrated that we have been able to maintain our margins. So we don't see a challenge that. On your questions of raw material price, yes, we have seen some price increase, and we have also seen some higher price acceptance for our finished goods in the market.
Okay, and so how much of your raw material do you export? And if you can brief on what are the key raw materials that are used in the production process?
We have multiple raw materials as our process. We use hydroquinone, we use diphenyllamine, we use piperidine, and a lot of different amines we use. We also use different olefins and alcohols. So there are multiple raw materials, but a couple of them, and the clove oil, so which are high value product.
Okay. And another thing, if I may know the current cost of debt for the company, additionally, do you still maintain your guidance of a 3x debt to EBITDA ratio for FY26? Or are there any updates or adjustments to that target based on current market conditions?
Our current cost of the debt is 8.6 to 8.8 in between that fluctuate, depend on how much we use as a packing credit, which is a little cheaper than our working capital. Number two, what we are giving guidance to bring down our debt to EBITDA by FY26 to close to 3.5 is very much in place, and we are confident we'll be able to achieve that.
Okay. That was helpful. Thank you.
Thank you.
Thank you. We have the next question on the line of Sayam from Invert Capital. Please go ahead.
Thanks for the opportunity. Perhaps my first question is, I'm relatively new to the company. So the new plant that we have set up in terms of the tonnage volumes, it is 20,000 tons, which is, significantly higher than our current capacity. But in terms of revenue addition, we are just guiding for, doubling the revenue. So is it that fundamentally the products that we are pursuing at the new plant are lower value per kg, or is it like some larger product categories which earlier we were not doing at the Vapi side? If you can just help me understand this a little bit, it would be really great.
It's totally a different product. Means the product which we're making Vapi has moved to the new facility, but they all are of the lower price band, not the higher price band of product. So that's why our guidance for the new facility is only up to 500 CR for a full capacity level.
So when they are lower price per kg, are they also lower GP, or the GP is sort of similar to what we have been doing in the market?
I think GP is somewhat similar or slightly better than what we're doing.
Understood. Secondly, to my understanding, like last quarter you had mentioned, this is as of November, I think that, any fundraise plans seem to like a bit premature to comment on, but then in December we have actually done fundraise. So are we looking at, a slightly elongated capacity utilization or ramp up, as compared to our original expectation, or this is more from a point of view that, that there are multiple opportunities beyond what we have done currently? So because I thought that, we were quite comfortable with the debt levels that we were operating at earlier.
I think there are multiple factors which I already said. Number one, we have certain new product which we want to start manufacturing, and we need to capex there. Okay, so that will happen. That will happen in FY26. And number two, yes, there was a slight delay in ramping up the facility, 2 quarters. That is not a pressure, kind of it. But we thought that let's deliver a little bit. We need to also make some capex into the new chemistry. So better to raise a fund rather than just stressing for the balance sheet.
Understood. And going by our earlier guidance, so let's say, this Q4 FY26, we do reach 85-90% of the utilization. So are we going to trigger further investment in the new product that you have talked about, once we surpass that 70% mark?
Absolutely.
And that would be executed faster, right? Because now it would be brownfield capex. So you'll be just adding the plant and machinery and not building the entire block.
I can't comment on that. What plan we come up, everything depends on that, and it's premature for me to talk on that since we are not ready.
Okay, thanks, sir.
Thank you.
Thank you. In the interest of time, we will take the last question from Mr. Sahil Vora from ANZ Partners. Please go ahead.
Hi, sir. Good evening. Thank you for the opportunity. Am I audible?
Yes.
Yes. I had a couple of questions. Sir, firstly, can you elaborate on the reasons behind the delay in the ramp-up at the Pakhajan plant? What factors have contributed to the lower than expected capacity utilization at this stage?
I have already mentioned, my dear friend, that some of the places the full approval was not in place, and some of the places customer RFQ were not, their customer were not ready to reordering or for the long-term contract. So those are the things. So that's the reason. And the third will be due to the December ending. A lot of customers were not willing to accept the material because of their closing. So the ramp up has been slow.
Okay, sir. My next question is, can you, following the recent capital raise of 125 crores, can you outline how you plan to allocate these funds? Specifically, what are...
You just joined the call. This question has been repeated 3 times. I don't mind giving answer, but this question is okay. We are going to repay 50 crores as a debt, and the balance 75 crores we are going to retain with us, which will be used currently for the working capital need, and next year when we have plans for expansion, we'll use the fund for that.
Okay, sir. Thank you.
Thank you.
Thank you. I would now like to hand the conference over to the management for closing comments.
Thank you very much, everyone, for your time. Appreciate it. Have a good day. Bye-bye.
Thank you. On behalf of Yasho Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.